Well, hello, my friends. If you're new to the channel, my name is Andrew Michael. I'm a local real estate agent here in Northeast Florida, and we're going to do something that I very rarely ever do on this channel. I'm going to have a guest on, and we are going to answer some of your top questions about lending. So I invited my friend Rachel Miller, who has been a lender for a long time, to answer some of your questions. So, Rachel, how you doing today?
Morning. I'm good, Andrew. Thank you for having me.
Well, thank you. Appreciate it. So tell our friends, where do you work?
I work at Ameris Bank Mortgage. I am primarily here in Volusia County in Central Florida, but I service all of Central Florida, Northeast Florida, and can actually, through Ameris Bank, loan in 48 states. So I'm able to spread my wings a little bit.
Oh, very good. And all right, and how long have you been a loan officer?
I have been a loan officer for the most part since 1999, primarily in mortgage since 2016.
Okay, cool. So you did like commercial loans or something before
I
that?
also did some commercial, small business, all of those things. I've done the whole gamut.
So for our friends, and it's outside what we normally talk about here, but what she was saying is that she did loans like for businesses, stuff like that. So, but okay, cool. All right. So today we are going to answer your top mortgage questions. And without further ado, so the big to do right now is how the Fed has cut interest rates. So the first question I have for you, Rachel, is how does the Fed interest rate affect mortgage rates?
Well, I've had that phone call a lot in the last couple of days, as I'm sure you can imagine. The Fed rate does have an effect on mortgage rates, but it's not direct, like point for point or dollar for dollar, as most consumers assume that it is. Mortgage rates are tied to the 10-year Treasury yield, which is the rate paid on the Treasury bonds. You may hear them called T-notes, which is basically mortgage-backed securities' number one competition in the market when it comes to seeking investors, et cetera. And so we follow that rate. So when the Fed rate drops, that actually has a direct effect on that 10-year Treasury note, which then over time will have effect on the mortgage rates. Now, also keep in mind, something I've said many times in the last couple of days, as soon as the Fed makes their announcement, which they did over a month ago, that rates are going to be reduced, then that slowly starts getting built into your mortgage rate because we have the expectation, what we're working on today is actually going to close in 30 days. So we need it to be competitive to the investor and go along with that Treasury note in 30 days from now. And so we have slowly seen that decrease in rate over the last month to get us to land where the Fed has reduced the rate at this time.
Okay, perfect. So let me just real quick, and I don't want to spend all day on this one, but when you say the investor, what does that mean?
So, the main reason for writing mortgages, there's not a lender out there that really makes their bread and butter from your monthly interest payment that you make each month. Typically, mortgages are bundled and sold off to an investor that is willing to purchase those loans from us. And because that investor is typically the same investor that's looking into Treasury notes, et cetera, we make sure that we follow along with that market.
Very good. Okay. And so sometimes does Ameris still manage let's say somebody buys a home, uses you as their lender. Chances are they still going to be sending Ameris Bank their payment every month, or is that going to get sold off to somebody else?
It really just depends on the type of loan, Andrew. Here at Ameris, we have a huge portfolio product line that those are typically kept right here in-house. If we're doing standard conventional loans, they're almost immediately moved to our servicing company, which is Dove & Mule. We own it. But then, of course, a good portion of them can be sold off to an additional investor if that's what we see fit to keep our reserves up and available to loan to the next borrower.
Okay. Now, let me ask you this. Let's say you do sell it off. Do they still send the check to Ameris every month, or do they send it to somewhere else?
They'll send it to somewhere else, yes.
Okay. Very good. All right. So let's move on to the next question. And thank you very much. That was very informative.
Yeah. And anytime that it is sold off to someone else, that is the only portion of that loan that can be changed is where you make your payment. That contract with that rate and that term and everything that we've put in place throughout the loan process cannot be changed.
Well, there you go. In fact, now you're leading into question number 2. Can mortgage rates decrease In other words, once we set that mortgage, they buy the house, can the rate come up or down?
If it is a fixed rate mortgage, no, not without a refinance. And typically that's what you see the consumer wanting is that fixed rate mortgage because, for example, over the last 2 years, anybody that had an adjustable rate mortgage was probably a little bit uncomfortable with the trend in the market. So we may see as the rates go on a downward trend, we may see a little bit more comfort with the consumer in an adjustable rate mortgage because they could buy something now and be able to take advantage of the rate reductions as they come, which are projected, but I don't have my crystal ball. So, we may see some more comfort around those in the coming months and year, but it's typically a fixed rate mortgage, and those would have to be refinanced in order for you to get the benefit of a rate reduction.
Okay, so let's say I buy a house, in my case, with a VA loan, and my interest rate is X. It's going to stay X unless I refi it, or correct, as long as the loan's alive. So
That's
even
correct.
if you change it to other service. Okay, so to answer that question. Cool. All right, now, next up, what is 50 basis points in a mortgage?
50 basis points is 0.5%. So you'll hear mortgage loan officers say like, oh, it's 100 bips. 100 bips is 1%. And the reason that it's stated that way is because on the backside, every rate that we have has a cost to it, and it's tied to those basis points. And so, but the basis points equal, 50 bips is 0.5% in mortgage land.
Okay. Now, how does that affect the consumer directly?
I mean, if their rate is 50 basis points lower, then they're saving 0.5% on their interest rate. But as I said, with the Fed dropping the rate 50 basis points, there were a lot of consumers that expected to talk to me on Wednesday after they had spoken to me on Tuesday and get a quote for a rate 0.5% less. That's not necessarily the case. We are recognizing some rate reduction, but those have been built into the rate over the last several weeks.
Okay, very good. That actually leads into the next question. Who sets the interest rates?
Well, the lender has the ability to set the interest rate. For example, every day when the market's open, then usually about 10:30, I can get live rates. And so up until that time, I'm working off of yesterday's rates. And those are set here in-house by the lender. However, they're always going to be very comparable because we're all looking at the same investors to possibly purchase those mortgage-backed securities, and we're all looking at the same 10-year treasury yield. You will see some variance sometimes just if the lender has an appetite for one thing more than another, which is solely based on their portfolio and what they're heavy in or light in. So that's where you may see some variables on investment properties, on secondary homes, on portfolio products, things of that nature. But for the most part, your conventional FHA, VA loans are all going to be very comparable, even though all the lenders are setting their own rates because they're all setting it based on the same data.
Okay. And I've noticed that's interesting too, because I've worked with buyers over the years, especially in the higher interest rate environment that we're in now. And I've had some of them where, we're under contract and they find something online and they get all excited. And I'm just like, damn, that rate's like crazy. I haven't seen that in a few years. And then we start getting in the weeds and they apply. Well, then it turns out that all of that wasn't, or there's fees, or it was kind of like that game with the shell where you put the marble under one of them and they move it all around the table.
It's a little bit of smoking mirrors. And I mean, I tend to make the joke with my buyers like, oh, I can give you any rate that you want if you're willing to pay for it, so there has been a lot of advertisement and stuff over the last few years as rates have gone up, where lenders are promising lower interest rates or offering buy down programs or things like that. And I like to sit and do the math with my borrowers to see what the cost of the rate is versus what the amortization works out to be. So, how long it takes to pay for itself. And then you also have to look at how long you think it's going to be before the rate comes down to that amount. So I like to do the math both ways so that my borrower just has the ability to make an educated choice. But there's no such thing as a lender with an astronomically low rate unless they have built it into their cost.
Yeah, exactly. Yeah, it's that always turned out to be the case.
Nothing's free. Nothing's free.
All right, I'm not gonna touch that one. All right. Is it better to sell your home before buying another? All right, now you and I both would have a different perspective on that one, maybe as a real estate agent and a lender, but I'll let you go first.
It really just depends on the borrower. I mean, obviously, from a convenience standpoint, if you can buy your new home and transition over to it and all of those things, that's very convenient. It really just depends on whether or not that borrower has the ability to carry the expenses of both houses. If they can, then I'm all about it because it's going to be convenient for them. It's going to be convenient for the realtor, and it takes out some of the red tape. So I always look at, pre-qualifying them or getting them approved based on them maintaining that initial home first. But if they need those proceeds in order to be able to close, or if they can't carry the cost of both homes at the same time, then obviously we would have to sell the first home first.
Also, too, you could run into an issue, correct me if I'm wrong, with VA buyers. So for me as a veteran, I only have so much entitlement.
That's
And
correct.
so so that could cause an issue. Now
And
it
so,
may not. It depends on how much I'm borrowing.
yeah, it depends on what you're borrowing and what your eligibility level is. And so, if we do a simultaneous closing, I have those done often where we can renew that benefit right there at the table and transition it to the new loan. So there's some different options and different paths that you have to take when you're dealing with eligibility of a VA loan. And there can also be the same thing with FHA. You're not supposed to have two FHA loans at the same time. So there's some additional documentation that you have to do, et cetera. But for the most part, if you're just working on a conventional loan or even a portfolio loan, then you can keep that other one and transition to your new home so long as you can afford it.
Okay. Now, what I'm about to go into, now this part does vary lender by lender. I think you would agree. Let's say we do that. Let's say I don't want to deal with people in my house during showings. Excuse me. I don't want to live in this house while people are doing showings. It's annoying. I got to have the realtor in my house doing open houses on the weekend. I got to clean up, leave the house so somebody could not even show up and not bother to tell us they're not coming.
Right.
Somebody comes through with COVID or some other sickness or, whatever. There's a million reasons why people don't want, it's like they don't want to list their house for sale while they're living in it. Mm-hmm. But if I were to move my next house, in my case and most other people's cases, I'm going to use the equity. I purchased my house back in 2014 for $285. I want to say I owe like $170, and I could probably sell it for around $600, give or take. So I'm going to want to roll that equity into the next house. But in most lenders would require, now there's something called a recast. Mm-hmm. Can you explain what a recast is?
Sure. So if I have a scenario where you're going to be able to maintain your old home, move into the new home, and then list the old home, and you want to transition that equity to your new mortgage, I will get you into the new mortgage for, minimal funds down so that you can, get into it. And then once you have that lump sum from the sale of the other house, and you've made 6 payments on the new loan, I will put that out there. That's one thing you have to do. But once you've made 6 payments, then we have a recast option on the biggest majority of our loans where you can apply that principal balance, all of the terms and rate, everything that's on your mortgage contract will stay in effect, but we will re-amortize that loan based on this large principal reduction, ultimately reducing your payment in the appropriate amount for you to still pay that loan off in the 30-year term at the rate that you have, but with a lesser balance because you've applied that principal.
Okay. All right. So that's recasting, but I think we could all agree that we are not in a stable market right now. There's all kinds of weirdness going on. The real estate market sure is hell in flux. Interest rates are in flux. Whenever people ask me what I think the real estate market's going to do, I was like, well, pretend I came to you pre-COVID. And I said, look, there's this place in China that and it's either came from a wet market or a lab. I'll let you decide. I don't care. But here's the thing. Buy all the toilet paper you can. Buy all the bleach, gloves. If I had said all this stuff, you'd have kicked me out of your house.
Right.
But it all happened. So I don't know what the hell's coming tomorrow. My point being, but if I were to recast in the scenario you just said, and the interest rates come down in the meantime of that 6 months, does that help me?
Well, at that point,
let me ask that question a different way. the interest rate would still be the same if we recast it. So I buy my new house, I put minimal down, I sell my old house, I then 6 months later take that extra money, put it towards the mortgage. We basically push the do-over button, more or less, but the interest rate's the same, everything's the same. And again, not all lenders offer that recast. Is that correct?
That's correct.
Okay, so this is something that's going to vary lender by lender. But what is another option? Let's say in the meantime, in those 6 months, the interest rates do come down. What is another option that I might have?
Well, I'm constantly keeping an eye on every loan that I've written to see at what point the rate will reduce enough for a refinance to be a good option for them. And so, we're constantly, especially now that we know we're in a, declining rate environment. We're looking for that refinance option. I know. Yay. We're looking for that refinance option for all of our borrowers. And, here at Ameris, we have made the decision that if we are still servicing the loan, if we have the loan in our portfolio in any way, then we're able to offer a refinance at no cost on our side, no bank fees. So that they can take advantage of that lower rate and we can retain that client in our portfolio. So it definitely has to be explored on a case-by-case basis. We can't do 100% of them, but the biggest majority of them we will be able to do.
Okay, so 2 questions out of that. When
Sure.
you say free, and okay, so the bank doesn't charge, but oh, hey, look at that, forgot about that. But they still have title fees, other expenses that come with, correct? So what would those other fees that you don't personally pocket and the bank doesn't make money from, but what are those other fees, just so they know?
In any mortgage loan, there's a number of outside vendors that we have to use. First of all, because it's not our area of expertise, but second of all, these outside vendors being a part of the transaction keeps everyone honest. If I owned the appraiser and the title agent and the county and, all of those things, then obviously it could get a little squirrely. So I love the fact that we have these outside vendors for checks and balances, but obviously they're not going to work for free. So you would still have an appraisal fee if that's relevant. Sometimes we get a waiver on those, but not always. And then the county, of course, is going to want you to pay to record that mortgage. The title agent, who's the middleman, has to make sure that we have clear title, provide title insurances, et cetera, is also going to expect to be paid. So there are still some fees involved in it because of those outside vendors that have to be used on every transaction, but the bank is not going to charge an origination fee for doing it.
Okay, now that being, okay, so that's that. But just to put some context on it, the county fees are not going to be very much. The
No.
appraisal, you're looking at, let's say, $400 to $500, unless you have something complex, like if you have a 15-acre property or
Right.
you have like a dairy farm on the backs. It's something kind of different, which is not what people watching these videos typically buy. I mean, we're here, most of the people that we work with are relocating. Some of them are local, but a lot of them are relocating and they're buying single family homes like in Nocatee or other neighborhoods to raise their families in.
Yeah. And for the most part, that's a $500 or $600 appraisal at most.
5 to 600, okay. And you've got the county fees, which are minimal, and then you've got the owner's title insurance, which is a lot, but that's going to be at a discounted rate because you're within, I think if you do it within 2 to 3 years, it's discounted.
The owner's title insurance won't have to be redone on a refinance. The lender's title insurance will be redone, but you'll get a reissue credit here in Florida because you already purchased a policy when you bought the house.
Okay, so there are costs now. Okay, now my second question then is when you said most of them in your portfolio, and again, most of the people watching this channel and the ones that our team work with are buying, they're buying a conventional mortgage, maybe a jumbo mortgage, VA loans, stuff like that. They're not portfolio products. We do those. And just so the viewers know, let me know if you disagree. A portfolio product is where the bank is loaning their own money, and it's what's called a non-conforming loan, meaning it's not your normal, like we're buying an unwarrantable condo or we're buying something that doesn't fit the box for a conventional VA loan and stuff like that. Would you agree with that?
I would, yes.
So that's going to, I don't want to go into that because that's a rabbit hole and that's outside of what most of our viewers are kind of looking at.
Yeah. And I probably kind of confused the terminology a minute ago because, we have a line of portfolio loan products. But when I say if we still have the loan in our portfolio, I was meaning It could be a conventional loan that has not been sold off to an investor, and we are still managing and servicing that loan. There are some requirements and a little bit of restrictions, should I say. Let's say Wells Fargo, for example, is a huge investor that bundles of mortgages are sold off to. So if Wells Fargo has paid me being a Maris for a bundle of loans and purchase them, well, they are probably going to put some limitations on whether or not I can solicit those clients for a refinance, because those loans actually now belong to them. So they are then going to offer those clients a refinance, more than likely with the same scenario as what I'm presenting for the loans we're servicing. I can't speak for them necessarily, but that's where you see some restrictions come in, is if, you know, it's typically within 6 to 12 months if the loan's going to be sold that we sell it. But that investor that purchased it will likely be the right person for them to request that reduced cost refinance at that time, because I'm going to have some restrictions on being able to solicit them. Now, if they call me because I'm their trusted loan officer and say, hey, Rachel, you sold me to Wells Fargo or whoever, but I want to refinance, then I can have that conversation with them. It's just reaching out and soliciting them if it's been sold off is not the best idea.
Okay, well, very good. I think we answered. Yeah, this is something, honestly, we could talk for hours about some of this stuff, but nobody's gonna watch it that long. So I think we hit all of the options here. So before we jump off, I just want to say real quick, thank you very much for everybody for watching us today. Now you'll notice there's a couple of different playlists. We have 2 different channels. We have one where all we do is tour model homes. So if you're interested, you want to see homes for sale, you want to see model homes, but you want to go beyond just looking on Zillow and stuff like that at the pictures, definitely check that channel out. We also have this channel that you're watching where we do more general information for people either relocating or currently living here, but looking to purchase homes in Northeast Florida. Definitely check that out as well. And then we have playlists within that. So for instance, if you want to learn more about Nocatee, last time I looked, we probably had between both channels, we probably had about 40 videos. So if you watch those videos, you will see everything that there is. And also, if you're looking to make a smooth transition here, again, if it's either local or if you're making this transition from somewhere else, then definitely give us a call, shoot us a text. The numbers are down below, and we would absolutely love to help you. And I'm also going to put Rachel's information down there too. So if maybe you're looking to go to other parts of either Florida or other states that she works, and we'll have that down there as well, you could definitely reach out to her directly too. Rachel, thank you so much for your time.
Thank you so much for having me. I had a good time.
Yeah, this is fun. We should do this again.
Absolutely.
All right, man. Well, you have yourself a great day. We'll talk soon.